I hope you all feel energized after lunch. Faisal and I will take the next 45 minutes to talk you through some European tax developments. And there were a lot. We really had to pick which subjects we would choose, and that already lets the room know how much developments are going on at a European level. To start off with, I thought it would be good to give you a brief introduction into the European Union so you know where all this legislation comes from. And no, you are not in a geographic class right now. What I'm showing you is a map of Europe. But note that not all European countries are part of the European Union. So what is the European Union? The European Union is basically a supranational union based in the field of politics and economics. It started off with 6 countries in 1993 with the Maastricht Convention, and currently we have 27 member states. And we try to be one unified union in the field, like I say, of politics and economics. And some features we have is, of course, one joint currency, the euro. We have a common citizenship, so people can freely travel around Europe. There are no borders between Europeans. And we have a common policy in the field of security and foreign affairs. We also, it's not only countries joining, we of course also had our first country leaving, which was the United Kingdom, of course, with Brexit in 2020. Now, a little bit more about the European Union, because you may have heard of all these European tax laws, but where do they derive from? So basically, this is our European Union, and we have 2 types of law. We have primary law, which derives from the Treaty on the Functioning of the EU, and these contains our fundamental freedoms. Think of the freedom of capital, the freedom of establishment, and the freedom of the worker. So they can all freely work around in Europe without getting permits or whatsoever. And the second one, the far more important one, actually all the ones we will be discussing today, is the secondary law. And those are directives, which are formed by the European Commission and are approved by the European Council. But all our member states have our own authority in the field of taxation. So if the European Union agrees on new tax laws, these all have to be then translated into the domestic laws of each of the member firms. And how does it happen? As follows. So we have 4 institutions in the European Union. We have the European Commission. They are the ones who draft the proposal, who have the right to initiative in case they have a proposal. We have the European Parliament. And that's a very important one because that's the only institution which is directly elected by the European civilians. And we have the Council of the EU. And the Council of the EU consists of representatives of each member state, usually in the field of taxation, the Minister of Finance. And it's a really exciting time now. And why is that? Because in June 2024, so in 3 months' time, we will be having re-elections in Europe. And the tendency in Europe towards the EU or contra the EU shifts, as you might understand. So with the current presidency of Belgium, because the presidency rotates from member state to member state each 6 months, is really heavily pushing now on get some of the topics across the finish line before June, before we have a new European Parliament, which will certainly have different topics on its agenda. So looking at the Belgian presidency, as I said, Belgium took over from Spain, and Spain, unfortunately, couldn't really get a lot of proposals across the finish line because of the fact that they had their internal struggle in terms of forming a parliament in Spain themselves. Now we have Belgium, and like I said, that will be an interesting period. The member state who is the president of the 6 months period of the council always informs the member states which its priorities are and what proposals they want to get across the finish line. And Belgium clearly indicated the following. So they really want to move forward with the BEFIT package. Faisal will elaborate on BEFIT in a bit. That's basically a consolidated tax base. ATAD 3, I will elaborate more on that. That's the Unshell directive. It will target holding companies with limited substance in Europe. It will frequently work on updating the EU lists of non-cooperative jurisdictions, so the blacklisted jurisdictions. It will also monitor if the various member states in the EU correctly implement Pillar 2. And after giving you a brief overview of how the EU is formed and how the legislative proposals work, thought it would be good also to give a slightly bit comparison between the OECD, because here we have that European Union, 27 member states who form tax policy. And then we have the OECD, over 140 countries in the world who also form their policies. The EU takes part in a permanent delegation of the OECD. And as you all know, great example, Pillar 2, where the OECD member states all agreed and some implemented. I know Canada is one of them, Japan is another one. But in 2023, also the EU decided we will implement Pillar 2. And as per 2024, as such, Pillar 2 is applicable in the European Union. Now, let me tell you a little bit more about Pillar 2. So what is the background of Pillar 2? Pillar 2, as most of you know, was basically introduced in the BEPS project, and it intends to stop the race to the bottom in terms of corporate income tax rates. What we saw a lot happening in the world is countries competing with their attractive corporate income tax rate or other facilities to attract businesses to invest in their countries. And that was basically a thorn in the eye of many tax authorities. And in the base erosion profit shifting program of the OECD, it became clear that this race to the bottom should be stopped. So what Pillar 2 basically entails is that it says, if you are a group company, you should at least have an effective tax rate of 15% in all of the countries in which you operate. And if you do not meet that 15%, then we will basically top up it until you meet that 15%. And later on in some calculation examples, I will show you how that works out. So I had a client of mine say, well, that's fairly easy, Monique. I have my ETR, so I'll just provide you with that information and let me know if I meet it, and then we'll just pay that top-up tax, if any. But unfortunately, that is where it becomes complicated, because what it does, this Pillar 2, it basically introduces a complete new set of rules, not only to determine the taxable base, so what income, but also what taxes are involved when calculating your ETR. So that is quite a complicated process with which a lot of companies are struggling. Now, there is one advantage, and that is that Pillar 2 isn't applicable yet. I say yet because there is an intention to lower the threshold. But for now, the threshold is set at a group turnover of 750 million. So if you have a group and you don't meet that threshold, then you do not fall in the rules of Pillar 2. Furthermore, there are some exemptions. Investment funds, pension funds, and real estate companies are exempt from the Pillar 2 rules. And there are also some safe harbors, because you can imagine, okay, now you fall in the scope of the Pillar 2 rules. You need to make all these complex calculations. You also need to file a tax return at the ultimate parent entity, so quite complex. So if you need to do that in every country, then the EU was like, well, that goes a little bit far. I think the OECD said that as well. So they have some safe harbors. And the safe harbors basically mean, well, we do know that in some instances, these compliance burdens go way too far. And we want to exempt some companies in countries from those complex calculations of the ETR. And here you see some examples. For instance, the de minimis safe harbor. I think I heard you about also a de minimis rule in your interest deduction limitation, William. But here we also see one. So if you have a group, and yes, you meet that threshold of 750 million, you do not fall in one of the exemptions. But you have a very small operation in a country in which you make a turnover of 5 million or profit of less than 1 million, then they say, okay, you do not have to make the complex calculation. We do not charge you a top-up rate. You're fine. And then there are two other exemptions also, the routine profit test, safe harbor, for instance, that basically says if your profits do not exceed a certain percentage of your substance, then we also carve you out. And that is that they do not want to hit the real operational entities. Let me give you a brief overview of the timeline of Pillar 2 and how that all came to fold in the Netherlands. Like I said, the EU agreed, all countries, all 27 member states have to implement Pillar 2 per 2024. And we go a long way back. BEPS action number 1 was already made in 2015. We saw the OECD, yes, coming to a joint statement, but not every country by far has, although they committed to implementing Pillar 2, didn't do so yet. The EU was like, okay, if the others don't, we will. So the EU did. In the Netherlands, that led to a process of Pillar 2. And in 2023, it was accepted. And now it's applicable in 2024. And what does that mean from a compliance perspective? So what if you are a company meeting the threshold of 750 million, you have a company in the Netherlands, so what should you do now? Well, actually, your first reporting then already starts in your financial statements 2023. Because your auditor, if it's a good auditor, will most likely ask you whether you have completed your Pillar 2 a feasibility analysis. And it isn't a big one, but because the Dutch Accounting Board has mentioned that in your 2023 financial statements, if you fall under the threshold, you should report what you have done. So did you do a feasibility analysis on Pillar 2 in the countries involved where you fall into them? Then 2024 is your first year, so it's applicable then. A lot of companies should then, of course, already calculate their deferred tax assets. So we now have a company, an example, a group which is situated in Dubai. Dubai in the United Arab Emirates has a corporate income tax rate of 9%, below the threshold. So we have to say something in the 2023 financial statements. We also have to calculate the deferred tax asset and liability, of course, and what the top-up tax should be. And subsequently, in 2026, you have to file as an ultimate parent entity your return. So in the end of the 1.5 year, you file your return, which is a new return. It's not your typical corporate income tax return. It's a new, complete new return, which you have to file on Pillar 2. Now, I was just telling you about the rules which can be imposed to reach an ETR of 15%. And I tried to make some examples which are fairly easy so you can see what's happening. Like I say, if you are an ultimate parent entity, let's say in Canada, and you have a group entity in the Netherlands, which has an ETR of 9%. And now you would say, why 9%? Because the Netherlands has a far higher corporate income tax rate. That's true. We have a corporate income tax rate of 25.8%. But we have an innovation box. And this company is an innovation box company. And as such, it has an effective tax rate of 9%. And that is, of course, below the 15%. So let's keep it simplified. Your ETR is 9%. Too low, right? Well, the first rule, which the EU and the Netherlands has introduced, is the QDMTT. It's the Qualified Domestic Top-Up Tax. And basically, that entails that the Netherlands itself can first top up until 15%, so that it, of course, keeps those tax benefits. Because if not, the other country can apply the second rule, which is the income inclusion rule. And that income inclusion rule works as follows. Now, let's say the structure I have, client of mine, is situated in Dubai. They have a corporate income tax rate currently of 9%. A couple of years ago, they still had 0%, but they have 9%. Dubai didn't implement Pillar 2, so they won't apply rule number 1, right? The QDMTT. So they will not top up because they do not have the Pillar 2 rules yet. Then the Netherlands is allowed to apply the income inclusion rule. So the Netherlands will file the corporate income tax return and will levy an additional top-up tax of 6%. So it will generate an additional 6% of the taxation. And what you will see here, that's interesting to note of Dubai, so this is applicable as per 2024. I can already tell you, as per 2025, Dubai has announced that it will increase its corporate income tax rate to 15% for foreign companies. And that's, of course, obviously and very logic, because why would you give your tax revenues to another member firm? So looking forward, I personally, my Pillar 2 colleagues don't agree, because that's, of course, their business. I expect that in a couple of years, this will settle down, because most countries will have increased their rates, their effective rates, to 15%. So these rules make sense. And then we have another rule, the under-taxed payment rule. And that rule basically means the following. By the way, it's only applicable as per 2025. So that rule is not applicable yet. But that one works out as follows. Now, let's say you have an ultimate parent company situated in China. China hasn't implemented Pillar 2 as well. You have still your group entity in Dubai. And let's say Dubai didn't top up in or didn't increase their rate in 2025 yet, and is still at 9%. Then you would say, well, no QDMTT because Dubai doesn't introduce it. China doesn't have Pillar 2, so you're fine. No. It says then, if another group entity, and that is really a devil, has Pillar 2 rules, so let's say the Netherlands is a sister company, then although the general rule is that the ultimate parent company is the one who levies the additional top-up tax, in this situation, the Netherlands is allowed to get the 6% additional tax revenue from the Dubai entity. So we'll here pay the top-up tax. So that is really an additional rule to also tackle these type of situations where you have two non-Pillar 2 companies in your group. I understand it's rather technical, but I hope to have explained it a little bit on how these three rules work out. So again, the country itself, the QDMTT, the parent company, or another group company. Now, what is our approach? So how do we assist our clients? Again, a lot of companies, of course, already started making their feasibility analysis. So what we do is we are now currently helping our auditors to make positions for our clients who fall under Pillar 2. We help them calculate the deferred tax positions. We're starting with the first ones, of course, in Q1 2024. And we can then, of course, in 2026 also help our clients with filing this complicated tax return. And how does that compliance roadmap look like? So what is our approach, and what would I recommend anyone who falls under these rules to look into? So first, look at the scope. Do you fall under the rules? Do you have a group with that turnover of 750 million? Do you fall under one of the exemptions? Are there safe harbors in your group structure? And then it's up to data gathering, because then the complex thing starts where you need to gather all your data in order to calculate your ETR. 5 is calculating the ETR and what the top-up taxes are. 6 is who taxes, because we saw sometimes it's the company itself who does the top-up tax, sometimes it's the parent, and sometimes it's another group entity. And then the last step is filing the return. So Faisal, so yes, we talked a little bit now about corporate income tax rates. Now let's head on to BEFIT.
Yes, so let's go back to the European Union. And there's the first slide of Monique, in which we saw that the European Union has 27 member countries. And each country in the European Union has their own tax system, their own direct tax law. As you can mention, as a multinational company, you're operating in all those countries, and you have to apply different tax rules to each country, to each of your own branch in the European Union. So the European Union saw this as an uneven playing field, and it's not so efficient. And with the BEFIT, it's like a common control framework in the European Union, like European direct tax. They would like to make this more easier and more simple and more efficient. It's a bit similar to Pillar 2, because your starting point for the BEFIT calculation is also the annual accounts. And it also applies to the bigger companies like Pillar 2, for companies with a revenue of over 750 million, for European headquartered companies, and for non-EU headquartered companies, if your revenues are 50 million in the EU. So let me just discuss a bit how it works on a global level. Your starting point for the BEFIT is your annual accounts. Like Pillar 2, your starting point is your profit in the annual accounts. So you gather all the profits from all the countries in the European Union, and then you apply the BEFIT calculations. Those are like the direct tax, European direct tax calculations. For example, book-to-tax differences on depreciation, inventory valuation. And subsequently, you can also adjust your taxable results with losses of other member firms. And finally, you allocate the whole package of the results to the countries. And how do you divide those taxable results to the countries? That's based on the percentage of your contribution as a state in the European Union. So for example, if you have 20 in the Netherlands, 50 in Belgium, then 20 of 70, and that percentage will be allocated to the Netherlands. And finally, when allocated to the local country, the national can also apply the local law to it. And for example, if they have the local corporate tax rates, the local tax laws, they can finalize it and then file it with the tax authorities. This is another schematic overview of how it works and with the percentages and all the revenues together. And it's expected that the BEFIT rules will come into force in 2028. However, with a lot of these directives, they're a bit unsure if it will go on or not. And it's like mentioning that they will first look at Pillar 2, how that works in practice. And when that's really working well, then they will move on with BEFIT. But for now, it's 2028. Keep in mind.
Yeah, what these directives, like I said, it's unanimity is required. So one of the 27 countries which doesn't agree already is, in fact, is a veto. So what we see a lot happening is really politics, and we see Hungary sometimes really objecting against certain proposals, and it's like really negotiating to get every country in line, and that's why a lot of those proposals just do not make the finish line, or they make it, but it takes like a number of years for them to make it.
Yeah. And another thing, that's the head office tax. So just let me give you an example. If you're like operating as a head office in a European country, and you have a branch in another country, then you can create a permanent establishment. I think you all are well aware of that. And then you have to file a corporate income tax return in the head office state and a corporate income tax return in the permanent establishment state. That creates a lot of complexity. You have to file 2 tax returns in different tax laws. So the European Union would like to tackle this inefficiency by introducing the HOT. And what does the HOT entail? That entails that you can choose as a multinational that you only file the tax return in the head office state. So with all the results for the permanent establishment, you file it in the head office state with the local rules. And subsequently, the head office state will then apply the local tax rate to the profit attributable to the permanent establishment of the state of the PE. And afterwards, when filing the tax return, the head office state will transfer the money to the PE. So in principle, and to summarize, the head office will then file a global tax return with the PE results in it and apply their own rules. So you don't have to apply 2 rules of the PE and the head office state. And it's expected that this will be enforced in 2026. So we have to see if it will go on or not. But for now, 2026 is the deadline.
Yeah, one of my favorite topics. I've had like 3 webinars on this again, but each time it doesn't get across the finish line. So this is one of these proposals where the EU member states just don't agree. And again, keep in mind, Belgium wants to get this across. So what does ATAD 3? ATAD stands for the Anti-Tax Avoidance Directive, and this is the 3rd one. The 2nd one was the one who treated the hybrid entities as touched based on by Pierre, and the 1st one was the interest deduction limitation, amongst others. So this is the 3rd one. And what does the EU wants to tackle here? Great example. Well, not really great because it involves my own country, but the Netherlands in the past were rather familiar for their holding structures. Rolling Stones were a famous example of them. So what did the Rolling Stones do? Well, in fact, they did really nothing in the Netherlands. They just had a letterbox company. But the Netherlands, due to the fact that we have a very large treaty network originating from way, way back, and because of the fact that I mentioned how we are in the European Union, free movement of capital. So every profit, every royalty, every interest can flow up the chain through your EU holding company without withholding taxes, because that's the EU. And then we have non-EU investors, a lot of them which are treaty countries of the Netherlands. And we would get royalty income flowing from Europe into Americas, wherever you want, without withholding taxes, with no actual substance in the Netherlands. Other famous examples were Ireland, Luxembourg, Malta, holding companies with favorable tax regimes, but no substance at all. The European Commission did a proposal already in 2021 where they said, we really want to combat this. If you have an EU company, which we call a shell, so nothing in it, we will combat you. And how does that work? I will go into the gateways. If you are an EU company and you pass these gateways, and those are 65% of your income is passive income, so dividends, interest, and royalties. Think of the Rolling Stones example I was giving you. At least 50% of that income is from cross-border activity. And you have outsourced your management to a third party. So let's say a trust office. So you do not have directors of your own, but you have outsourced it to a third party. Then you meet the gateways and you are in principle a risk company. So here you have a flag. You're like at risk. Unless, that was the previous page, you are an exempted category. Again, ATAD 3 doesn't want to hit listed companies, regulated financial undertakings, and some other examples. So there are some exemptions. But let's say you're a regular company and you are flowing passive income in through a European holding company, and you have outsourced your management, then you are a risk company. So what happens then? You have to report on 3 items for the tax authorities to determine if they feel this is enough substance. You have to report whether you have an office space, and it can be your own, or it can be one which you share with another group company. You have to have at least 1 active bank account within the European Union. And you need to have at least 1 director which is resident of the jurisdiction of the entity, who is also really authorized and capable of making decisions. Or you should have a majority of employees residing in and from that holding company. If you meet those 3 criteria, you're fine. Then yes, you should report in your corporate income tax return, but you are not regarded as a shell company. There is a possibility to ask for an exemption or a rebuttal where you say, yes, I do pass the gateways, unfortunately, dear tax authorities. And no, I don't have an office space, but for clear reasons, because A, B, and C, I have someone working from home and I don't need that person to rent an office for this purpose. And you have a rationale where you say, yes, I have a shell company, but it's not intended to have a lower withholding tax rate. Then the tax authorities can say, okay, we grant you an exemption. We agree that you are not a shell company. But if you don't pass it, so if you meet the gateways and you do not meet the substance, then you are a shell company. And that means adverse consequences will be applied. The parent subsidiary directive and all EU directives will be denied, the tax treaties will be denied, and you will not be granted a certificate of residency. And with respect to a non-EU shareholder, as we said, non-EU countries, Canada, US, they can't be held to EU law. But what the EU does ask them is to say, hey, mind you, here we have an intermediate holding company with no substance. Do whatever you want with it, but so they say they give an indication to the shareholder state. How does that look like? Let's say you have a Canada, Dutch BV, and Italian SRL structure. The Dutch BV has passive income flowing through the Netherlands. And let's say if Italy would be held directly by Canada, Italy would have withheld withholding taxes on the interest payments to Canada. The treaty wouldn't be favorable, but we would interpose the Netherlands. Then we would say Italy to the Netherlands is the interest and royalty directives, free flow of goods, remember, so 0%. And we have a very favorable treaty with Canada, which we don't even need because we don't have a withholding tax on interest. So here, with this type of structure, you eliminate withholding taxes which might have been due on a direct interest payment from Italy to Canada. And then ATAD 3 blocks it and says, okay, you meet the gateways, you have passive income, you have outsourced your management of the Dutch BV, and it is that interest income is the most part of the income of the Dutch BV, you qualify. You don't have an office space at your disposal, or you don't have a bank account, or no Dutch director, then the adverse consequences apply. And in this case, this means that Italy will deny the parent subsidiary directive. It will just look through the Netherlands, basically, and will deem it to be a direct interest payment to Canada and will levy withholding taxes on the interest payment. So that is how these rules work. Again, it's a proposal which has been on the line for 3 years already. There were instances where we thought it will make it. It has been amended a couple of times. If you ask me, will it make? I think it will, but I'm just not sure anymore because of the fact. But after June, if it doesn't make it before June, it will be hard. Again, we will be having re-elections, and I have an idea that this will not be top of mind after the re-elections. This is a nice flowchart in which you can see how to determine it, because I understand it was quite technical, but this is a really ideal flowchart in which you can easily determine if you fall under the rules, if you have to report, and whether adverse consequences will apply.
Even if it will pass through, then the question is in how...
in what form?
In what form?
Yeah.
How many employees do you need? For what period? How many passive income do you need? So they might tweak a little bit, but...
Yeah, yeah. Agree. Another one.
So let me discuss the Deborah rules with you. Just go to the basics a bit. So in most countries, equity and interest is treated differently. Yeah? So what we see is that interest is usually deductible and equity isn't. And that's why, as we go back to the map in the beginning, we have 27 member countries, each have their own tax system, and all also have their own interest limitation rules. Each country has their own rules about this. And what the EU wants is to have, and currently all those countries have their own rules about how to tackle this difference in treatment. And the EU wants to have an EU rule on this to harmonize the treatment of equity and interest. And what this actually does, it's like a mix of, what can you say, like a thin cap rule and the earnings stripping rules. So what they actually do is they say, okay, you will get an allowance if you contribute equity into the entity. So that will be encouraged to increase equity. And on the other hand, the net interest will be limited in deduction to 15%. So you have like a combination of the interest, earnings stripping, and the thin cap. It's also really unsure if this will make it. And if it will make it, it will be in 2028 as well.
This was one of those proposals which came up after COVID, where the European Union wanted to attract equity to the EU and wanted to have funds. And they were like annoyed with all the debt and the base erosion due to that fact. And then they came up with this wonderful idea to attract more equity to Europe. But this one is really under debate. There are a lot of merits in it. I personally, if I would put my money on this one won't make the finish line there. It's also is what you see. Belgium doesn't give a priority to it. So not top of mind, but interesting to see what type of ideas the EU is busy with. DAX 7. So like we have ATADs, but we also have DAX. And this is already the 7th one. The 6th one is also an interesting one. I think Many of you have heard of that one if you did business in Europe. The DAC 6 goes on reporting of tax advisors. If they do certain tax advices which fall under one of the hallmarks, then we have to report that advice. But that has already been introduced a couple of years ago. Now we have DAC 7. And DAC 7 is yet another reporting deadline. And what is it about? Well, with the digitalization of the economy and the rise of digital platforms, think of Amazon, bol.com, those type of things. Bol.com, sorry, is a really
eBay.
Dutch company, but same like Amazon, eBay. It has become much more difficult for tax authorities to really see if sellers on those platforms really report all their profits, which they are generating through the sales on these platforms. The EU, again, wanted to tackle that, and they are tackling this by targeting, or not really targeting, but by imposing yet another compliance obligation on these platforms. So these platforms, qualifying platforms, are platforms, the ones which I just mentioned, which provide services which are there for the sale of goods, but even for the rental of immovable property. And they should report on sellers. And sellers are the ones who are within the EU and who carry out one of those activities on these platforms. So as I was saying, if you are an individual in Europe and you're selling goods, you're providing a service on a platform, or you're offering personal services, or the rental or movable of property, or transportation, then that platform will report. This is a directive which met the finish line. Actually, it has entered into force as per 2023, and our first compliance obligation was at the end of January 2024. I do have to say, as a Dutch firm, we are only serving 2 or 3 platforms, so it was rather limited, but it is good to bear that in mind, that that is another reporting requirement we have in the EU. And last but not least, we also have DAC 8, which also met the finish line. This is a proposal which has entered into force, or will enter into force as per 2025, I think. So this one is the one on the cryptocurrencies. Because in just over a decade, cryptocurrencies have basically grown from digital novelties to trillion-dollar companies. I guess a lot of people currently own Bitcoins or other cryptocurrencies. And as they are not regulated, it is, of course, very hard for tax authorities to track, again, same as with these platforms, if taxpayers really report all their cryptos in their tax returns. So again, to tackle this, they do not look at the user or the owner, but they go to the platform. So think of Binance, Bitfavo, which one, BCM. So it basically requires those platforms to share data on the crypto traders on their websites. It has been adopted. Yeah, sorry, I said the wrong year, but it's with all these proposals. So that will enter into force as per 2026. So that is applicable, and another reporting requirement we are seeing. So I guess a key takeaway, what we saw this morning, I got a question why it's interesting to do international taxation, specifically in Europe. Well, it's like never a dull moment. It's really harsh because you do not only have to do your Dutch tax law, but you also have the EU tax law, and where that was one proposal once every 4 years in recent years, now it's like 3 or 4 proposals each year. And like I said, this was only a selection. We didn't even cover SAFE, Faster, and a couple of other proposals which are at the table, but they were more for individual people, so we thought they were less of interest to this group at this moment. But it's interesting times. The compliance obligations keep piling up and piling up, although they say they want to eliminate the compliance burdens for companies, and they are trying to do that, is what they are saying with BEFIT and with HOT. And yes, that in principle is fair, but they give you like 6 other compliance obligations on the side. So In terms of really tax advising planning, it's becoming more and more strict, more rules also on us as tax advisors on where we have to report, what rules we have to obey to, and the penalties we can be given if we provide too aggressive ideas. And on the other hand, a huge increase in compliance burden. So that is basically, I would say in a nutshell, it wasn't really a nutshell, the updates from the European Union. I thank you for your time, and we will be at the cocktail party. So if you have any questions there, you can always ask me or Faisal, and thank you for your attention.